Welcome to Nasdaq Trade Talks. I'm your host, Jill Malandrino, Global Markets Reporter at Nasdaq. Joining us at the market site in Times Square, New York City, we have Bob Elwood. He's the Chief Operating Officer over at Practus. We're going to take a look at tax tips, opportunity zones, as well as Bitcoin. Bob, that's quite the potpourri of topics there. So my question is, what's your area of specialty?
Well, I focus, as you suspected, on tax and transactional issues. I'm also the Chief Operating Officer at Practus, so I deal with things like client development and recruiting and try to make sure everybody's happy.
So what are some of the top challenges that Practus clients come to you for?
Well, many of our clients are in the financial services area, so they come to us with questions like, how do I merge two mutual funds together? Or a hedge fund manager might say, how do I invest in an esoteric asset? Or it might be something as simple as one company wants to buy another one. What we do is we figure out how to do that in a tax-advantaged way and to make sure that they've taken care of all their regulatory compliance, and we help them make sure it works great that way.
All right, now coming to the end of December 2019, the last month of the decade, I'm sure you're putting out a lot of tax tips.
Sure. Well, there's three things that I really want to share with us today, and I'd say the same thing whether I was talking to a fund manager managing $1 billion portfolio or an ordinary investor. First thing is, if you have tax losses, you want to harvest them. So if you bought a stock that is worth less today than what you paid for it, you'd like to sell it, take the tax loss. That makes sense. Second, you want to make sure that you maxed out on your retirement contributions. For most people under the age of 50, it's $19,000 a year. If you're 50 or older, it's another $6,000 that you can put away. And last but not least, people this time of year tend to think about charitable giving. So it's a nice opportunity to give, and one of the things you might want to consider doing is giving appreciated stock. That way, the charity gets the money, you get a nice tax deduction, and you don't have to recognize any of the gain in the stock.
What about qualified opportunity zones? We're starting to hear more about them. Give us a little bit of background, and what are some of the tax deadlines for those?
Well, I remember there used to be this funny bit that Steve Martin would do on Saturday Night Live. He would say, how do I make $1 million and not pay any tax on it? And then he would go on to explain, well, first you make $1 million, and then when they ask you about paying the tax, you simply say, I forgot. Well, opportunity zones are kind of a legitimate way to do what Steve Martin wanted to do. The idea is if you have a gain and you invest that gain in a distressed area, there's a bunch of different parcels throughout the country that the federal government has designated. You invest it there for 7 years, you get a very reduced rate of tax, and if you invest it for 10 years, you get no tax at all. So it could be a nice situation where you could make $1 million, invest it into this opportunity zone, and not pay any tax on it at all. The key deadline, though, is that you have to get these done by 12/31.
Okay, now moving along to Bitcoin and cyber currencies, it seems as if the jury's still out in terms of tax treatment with those kinds of assets. What are you advising clients?
Well, the IRS has made this a high area of compliance, and they're making sure that everybody pays attention, even people who are investing $100 here, $100 there. The key thing is the IRS treats Bitcoin and other cryptocurrencies as property. So the whole idea is that each time you buy, each time you sell, you need to keep track of the amount that you paid for it, the amount that you realized on the sale, and keep track of things like dates and holding periods and other things like that. That can be a real burden on the record-keeping side for most smaller investors. So what you'd really like to do is make sure that you either invest through a tax-deferred account, like a retirement account, or you make sure that you comply with all these record-keeping requirements. The big thing, though, as a takeaway would be to say, whatever you do, you don't want to use Bitcoin to make a dinky little purchase like a sandwich. You could buy a sandwich for $10, you could end up having a ton of record keeping associated with that, and you don't want to have that.
All right, certainly sounds different than your traditional asset class tax treatment.
Well, yes, but the nice thing is a lot of portfolio managers like the asset class because it's not correlated with other asset classes, and it gives a chance to get uncorrelated returns. And in 2017, Bitcoin returned about 1,700%, and that's, a fairly hefty return.
All right, Bob, thanks so much for joining us at MarketSite. And thank you for joining me on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.